So we have Wednesday's daily candlestick or bar, then Thursday's smaller, which is it's higher low than Wednesday's and lower high than Wednesday's, respectively. And then we have Thursday closing with a small range day. And then Friday, we have all this buy side up here that has not been engaged. For Friday, because we're expecting the large range day expansion to occur, the direction is solved by looking where is the market leaving smooth highs or smooth lows. Well, we had Wednesdays drop down, but here the idea is that the large range day will usually occur after the small inside day. Whenever there's a small inside day, it's either the very next day or worst case scenario, the second day after. Well, you can't do that here on Friday because we don't trade on Saturday. So what are they going to do? They're going to rush. They're going to rush right at the opening bell. And you see that happening here. The open is the low of the day thus far. So what are they doing? They're rushing to get the market up here. Who is they? The algorithm. It's just simply running really, really quick to get to that level here because it doesn't want to offer the opportunity for any individuals that have their stops up there that have been holding short, looking for Wednesday's continuation on Thursday, but didn't happen. And then Friday, here it is. They run real quick for them. That sudden one directional run is going after that liquidity. So they can't pull their orders. The direction is going to be bullish. And one of the things I learned from Larry Williams is on large range days, if it's bullish, the open is going to be very, very low on the daily range. And I know that it's going to be in the lower quarter of whatever the daily range would be. If we know we're opening at 9:30 and we're going to view this, it's not technically the daily open, but I look at sessions the same way I would look at a daily candlestick. The morning session, the high and the low, where we start and where we stop, I look at it in this perspective. This is power 3. So I'm looking for the opening when I'm bullish, and I want to see manipulation. That's the drop down, because if I'm bullish, I want to see some opposing direction. That's the Judas swing. That's manipulation. And then the accumulation below the opening price or just above it, when it comes back down and touch it again, it does not need to come back and touch it. But if it does, that's all part of the accumulation phase. And then you have the profit release portion of the run. Then you go to the target, which would be the liquidity or some higher time frame PD array. That's these two levels here. But if you look at it through the lens of overnight and at midnight, there's midnight. It creates the opening here. Here's the low of the day right there. So this line right here, think about this crude depiction of a hypothetical daily candlestick, open, high, low, and close bar. That opening price is this. This drop down is this little tail that's making the low of the day. And then the market trades higher. It doesn't always, but it can come back and use that same opening price. Hits it. Then it consolidates. What's it doing? It's accumulating. It's accumulating all around that opening price. When you have a large range day expected, Larry brought a really amazing observation that I didn't notice. I never noticed that the opening would be near the low of bullish days. It was just completely, I didn't know about it. But because his material talked about that, I was like, wow, as a day trader, like that's a superpower. Like that's literally like one of the wonderful advantages if you're a short-term trader or a day trader. You want to try to focus in on days when it's likely to start a price run like this, where everything is in your favor, that it's going to go one direction, find the opening price at midnight, and then anything below that price as it drops down, if it agrees with other factors that would constitute a trade, then it goes without saying that you have a high probability that you're going to be entering below the opening price, where and when smart money would accumulate their long positions. And just know, if we have an economic counter like we had this morning, where we had 8:30 and then we had 10 o'clock news. So you got to be real careful on days that have that split news delivery, because sometimes it can create like a catapult type move or whiplash, where it sends the market one direction, not the data, but the algorithm will use that data and trip traders up, and they'll use the first set of data at 8:30, kind of like a FOMC, where the first run is the fake run, and then at 2:30 during the conference at FOMC, the real run takes place, and it's much larger in the opposite direction. Well, sometimes when you have split delivery on the economic calendar, 8:30 and 10 o'clock news like that, it can create those scenarios. But you can filter that out on days and circumstances like today, where we had bias was bullish, and when we're looking for the last trading day of the week to go for that targets or these targets that we had outlined here, that means that they're going to use the opening bell. And even though there might be a large gap here, even though that there's a 70% likelihood that it trades the mid gap, these are the circumstances and these are the types of days where it's going to say, not today. If we knew that the 10:30 to 11:30 hour, that usually creates the intermediate term higher low of the morning session, and then it invites the lunch macro to define where the order flow is going to be during that 2 hour period between 11 o'clock and 1 o'clock, or specifically 11:30 to 1:30. Okay, so lunch for New York is between 11:30 a.m. Eastern Time to 1:30 p.m. Eastern Time. The way that would unfold here is, let's say it is 10:30 right now. It's not. We have 11 minutes or so to go. What would happen is the algorithm will computate the range high and the range low, and then it'll define where midpoint is, or equilibrium. And then below that equilibrium price point at 10:30, then it'll start looking for sell side. And the lunch macro is always going to run on those that are profitable. That's what it does. Okay. That's exactly what it does. So sometimes it'll go down and just take the first pool of liquidity, and then it'll consolidate in the rest of the day and go no lower and make no new high. Other instances where it'll trade down, trade into the trailed stop losses, and then once it triggers that sell side, then it'll accumulate and start running higher and keep going in the rest of the day into the last portion of the day and close the week out strong on its high. So if we're looking for that range expansion, that big explosive price run that's occurring because Thursday was an inside day, our bias is determined bullish. We're expecting two news drivers at 8:30 and at 10 o'clock. So we have split delivery on the calendar. Normally, that would create a back and forth, and then after the final 10 o'clock news is released, then the real price runs for the daily candlestick range is delivered. Not today, because it's the last trading day of the week. We have unfinished business up here. So by looking at that at midnight, opening price, drop down, it trades back above it, trades back down into the opening price here, rallies, accumulates, accumulates. 3 a.m. What time is 3 a.m.? That's the heart of London session. So we would what? Expect the market to do what? Create some kind of a displacement. Does it rally higher? Yes. Does it go above a short-term high? Yes. Then the market drops back down. What is it trading back down into? An order block. Does it take the low out? No. Does it rally again? Yes. Volume imbalance, inefficiency, inversion, fair value gap. All of that's being clustered all in that same area right there. And then finally, at 3:30, trades higher. Runs higher to 4 o'clock in the morning. Trades all the way back down into the middle of the consolidation in here. And then at 7 o'clock in the morning, we have the AM session starting. Smooth highs. Trades up to and through, and then comes back down into this inefficiency here. If it's two inefficiencies, think about what I taught for Model 2022. This is the one you want to try to trade in, but your stop has to respect the second fair value gap. But because we know that the likelihood of a large range day is going to form today on Friday, because we had a small inside day on Thursday, meaning that the range on Thursday's daily high and low was smaller. The high was lower than Wednesday's high, and the low of Thursday was higher than Wednesday's low. So that means it's inside of the previous day's range. Whenever that occurs, you have the indication that there's going to be a large range, explosive large range, one directional move. When it happens, it's going to most likely deliver in the basis of a low resistance liquidity run condition. That means it's not going to be a lot of fuzzy price action. The approach to trying to force precision in days like when we have a large range day on Wednesday, where it's a big down day, the following morning session, you want to avoid that because it's going to evade you when it comes to precisions. What I defined in here, and I'll kind of walk you through this. This is pre-market, pre-session. If you look at the high here, there, that high is this rotation and then start to move all the way back down into this area in here. So what I identified is the body of the first high here, and this was like a stop hunt. So I ignore that. So I'm looking at this reference point here as the low, and it comes back down and hits it here. So pre-market, that means before 9:30's opening bell, 8 or 10 minutes after 8, okay, you're in a macro. So what's it going to do? It's going to spool, trading all the way back down, booking price down to the low over here. If we can define that range, once we have that, we can calibrate that to whatever the high and the low is at the time. Once it retraces back down to a discounted range and starts to move higher, what is it doing right there on that price run? It cleared this high. If you're really, really bullish, you can use this short-term high here. That's a shift in market structure. But here, this really nails the deal and says, okay, we've had 2 periods, 2 points of reference where the market traded above a short-term high. And then it gravitates right back down into order block, buy side and balance, sell side inefficiency, range high, range low. with those two reference points, and we're bullish, and we're expecting a large range day, and we're expecting that there's most likely not going to see, if we have a large opening range gap, we're not going to see what? Much, if at all, of a retracement into the opening range gap, because it's going to be go, go, go. It's Friday, doesn't have a lot of time. It's got to run aggressively for that buy side liquidity in the 600s. So because all those factors coming together like a perfect storm, it's beneficial for you to try to start looking for setups before 9:30. I get questions all the time. What made you want to trade before 9:30? You teach silver bullet. I thought we're supposed to be trading silver bullet. I thought we have to wait till 10 o'clock. That's you. If you're going to use that model, you have to wait till then. But there's always silver bullets. Every hour there's a silver bullet. What are we talking about? I taught this. Whenever I think that the market's likely to create a very large range day, or if it's so one-sided directionally, I will many times elect to trade pre-market before 9:30 and not do anything as entries at all after the opening bell because I'm already positioned. And then if 10 o'clock affords me a silver bullet that would allow me to do a longer term hold and convinces me that I should go through the entire lunch session and then see if I can pyramid during the lunch macro where it retraces, goes down into liquidity, I can add to that. Or if I've taken partials off, I can add them back plus more because I have unrealized profit behind me still because I've entered so early in the day before 9:30. But not every session before 9:30 should be traded. Not every one of them should be like that. There's going to be a lot of times where the market doesn't do much at all pre-market. And then at 9:30, everything comes alive and everything is very easy to trade. So if we can define this range from the high down to that low, as I mentioned a moment before I went on to my rant, we can then look at the grading aspects. When you have a dealing range, and we define that from this high here, and it's dropping down back to a PD array over here. This was a stop run. So we nixed this. We don't even pay attention to this candlestick. All that was a little bump to take that high, and then price went lower. It drops back down to a discount. I'm looking at this high here and the bodies drawing that out in time, that's the return to it here. And then we have a shift in market structure. You can define it with this high here, and there's nothing wrong with that in this case because we are expecting what? A large range day to deliver today on Friday because Thursday was an inside day. Using this one, it qualifies it even further because when it trades above this one, it's one candle, and then the next candle trades above that high. So it shifts market structure bullish. So any retracement back down into this inefficiency here should be viewed as what? A discount array. Now, because this high is the highest high in this retracement, in a market that's bullish, we can grade that price swing. I do this with actual dealing ranges, as you see here, and then also do this in price runs where I either expect to enter or when I actually enter the trade, and then where my target is. I know by doing what I'm about to show you here, I can predict where my future PD arrays are going to form. So here's your dealing range, okay? And equilibrium is the halfway point right here. So ideally, your best entries is going to be entered on a long at or below this line. Now, how can we use this information to pick the right fair value gaps? How can we use this information to pick the right order blocks? What we're seeing here is the quadrants that is grading this dealing range from the high down to that low. At 8:30, the algorithm kicks in whether there's news or not, but we had medium impact news driver this morning. So at 8:30, the market trades into our discount array, and then we wait for what? Displacement. We don't just go down here and start buying just because it's trading there. Let the algorithm tip its hand to you. Let the market say, listen, I'm going to show you what I'm about to do. Pay attention. So the market goes above the short-term high here. What makes this candlestick important? It's lower high here and it's lower high here, so that's a swing high. So when the market breaks above that, that's a shift in market structure. And then it displaces higher, and then we have another swing high. This candlestick's high is lower than that one, and then the lower high on this one. So there's a swing high there. It broke both of them, leaving what? This buy side imbalance, sell side inefficiency. A portion of the order block or a portion of the fair value gap must, listen folks, listen, okay? It must be at or below the quadrant level. Here's your lower quadrant level. Here's your fair value gap. Is this fair value gap at or below the lower quadrant? Yes. That means that this fair value gap is a proper candidate to be long when you're bullish. When time, 8:30, spooling at 8:30, that's the only 30-minute delineator for a macro. Everything else is 3:15 to 3:45 for the last hour trading. And then you have the first 10 minutes to the top of the hour and the first 10 minutes after the top of the hour. That's every hour macro. Okay, so there's your little skinny on the macros. But 8:30, whether there's news or not, the algorithm will start spooling. If it doesn't start spooling and running, then you just simply wait because it's telling you that it's waiting for the 9:30 opening bell. So what happens if you're anticipating something here and just meanders around or goes lower? Do nothing. By defining this with the quadrant level here, your fair value gap or order block, which is this down closed candle right there, is that below that quadrant level? Yes. Is this fair value gap at or less than this quadrant level of this dealing range? Yes. Now watch what happens. The market trades down. We have a little bit of a mohawk. That's fine because you have an order block there. That order block right here, why am I using that one? Because it has the lowest down close in with a body. So the body's projection lower, it's lower, and we don't use this wick. This is your order block right there. So half of that order block is a mean threshold. That price is 452.75. What's the low of that candlestick? Folks, that's perfection. So the market does what? It rallies back up, and look what it does. It delivers into this volume imbalance. What's it missing? Buy side and sell side delivery. So it lays a body up in there. So it buries a body inside that volume imbalance and then drops right back down into what? That swing high here. Rallies back up, leaves the lower quadrant, trades up to equilibrium, meanders around in here, and then causes what? Another displacement. What is this candlestick right there? It's a fair value gap. Well, ICT, why didn't you use this one? The majority of the body of that buy side and sell side efficiency is what? Above that quadrant. So here we have what? Equilibrium. We're at that precipice where if you're building a position in all this down here, pyramiding, we're at that halfway point of that dealing range. So that means you have to do all of your business at that price range here or less. Otherwise, if you start adding up in here or above it, you might see a retracement. Even though it's low resistance liquidity runs, meaning that we're not getting a whole lot of deep retracements. What's a characteristic of low resistance liquidity runs? Do you remember? Down closed candles will support price higher, and inefficiencies will leave a portion open. High resistance liquidity runs are going to see a lot of give and take back and forth, and every fair value gap will be closed in. Remember, if it's spending a lot of time in the inefficiencies, what is it doing? It's telling you what? We're inside of high resistance. That means it's going to be problematic for you. You're not going to be comfortable in it. It's going to be back and forth price action. Don't run your stop loss up real quick to break even. Just let it move or don't trade. That's the characteristics with it. So in here, we are in close proximity to equilibrium from the dealing range high, dealing range low. We've already accumulated down here, rallied up, equilibrium, retracement, and then displacement here. So we are seeing this fair value gap dead in the middle, consequent encroachment. We can now take that also. So because it's laying inside of equilibrium and half of that gap is basically overlapping that blue line, which is equilibrium of the dealing range, when you're bullish, how could you use that? Now you can try to put a limit order to buy right at the midpoint, trusting that it's going to leave the lower portion open. Notice how it left this down here open? What is that? It's a breakaway gap. This is a tradable fair value gap. But because the consequent encroachment of this gap, it's overlapping with the equilibrium price point or middle of the high to that low. So it's a convergence of two factors of equilibrium or midpoint. So this is where a institutional order flow entry drill would be optimal because you would expect what? Only a partial entry into that blue shaded area or fair value gap. So this is institutional order flow entry drill, or you can use the upper quadrant of this range and you would use that price plus one tick. And then this is a gap that is what? Below the upper quadrant. And this is where I would use to see if I'm on side. Anything above it, you're just using it for management purposes. So when this fair value gap forms, this is a valid fair value gap, but it should not fully close in. Why? Because we're in low resistance liquidity run conditions. We're in an early session of a potential large range day that's bullish, and we're at the quadrant, upper quadrant, and less. See that? So what does that create in here? This candlestick's low. That's an institutional order flow entry drill. That's an institutional order flow entry drill. That's an institutional order flow entry drill. Leaving what? Portion of the range open. That is telling you continuous feedback that yes, down close candles consecutively, that's an order block. Draw that out in time. Hits it. Does it support price? Yes. In and of it by itself? Nope. Half of this gap at equilibrium and an order block, this portion should stay open. It should not trade back down to this one because that's a breakaway gap. All those things are signatures and characteristic of low resistance liquidity runs. When you enter in here, your stop loss can be just below this candlestick's high because it's not going to go down to the lower bottom of that fair value gap because we're in low resistance liquidity runs. So if you know what the mechanism is going to be when it is seeing these things based on defining your dealing range, knowing where equilibrium is, if you're bullish, you're buying at it, below it, in every fair value gap, or in this case, order block. Isn't this an order block? Down close candle, down close candle, 2 consecutive down close candles. That's all one range. It's doing what? It's delivering price lower. Does that down close candle support price going higher when it comes back down to it here? Yes. Then price goes where? Higher. Down close candles here. 1, 2, 3. And then it creates that final institutional order flow entry drill, like it did here in this range here, going right below the high of the fair value gap. Same thing here. This candlestick's low. That's the high of this blue shaded area or fair value gap. This candlestick here, isn't that an order block? Isn't a down close candle when price is moving higher? Inside that candlestick's range, it's trading down into it. And it's rare that it does this, but sometimes it will. It'll trade to the low of the candlestick. I don't like that. I would never enter on a trade like that. I want to see half of a bullish order block, the mean threshold or higher to its high. I want to see price use that portion of it to trade down into and then repel price away. When you're looking for dojis or tails beneath the candlestick, like we're saying here and here, those are forming inside order blocks or inside fair value gaps. When the order flow is bullish, you can anticipate these things forming. That's why when you look at my entries, I'm always entering on the very lowest candle or the one candle before or the one candle after the lowest candle when I'm bullish. Now the market then leaves this range and breaks above the dealing range here, and then we're going into what? Into that 9 o'clock hour.